Hey everyone, welcome to today's Explainer. We're jumping right in today because we are stepping into the shoes of a Wall Street analyst to conduct a comprehensive audit of one of the most consequential companies on the planet, Google, or Alphabet if we're being strictly formal. The goal today is simple, but the answer is complex. We all know Google is a fantastic company, but does that underlying greatness actually make it a good stock to buy right now? We're going to unpack the raw financial metrics, strip away the noise, and look at exactly what the data tells us.
Okay, let's dive right into this. 91.53%. That is Google's staggering 10-year total return. If you had invested a decade ago, you'd have almost 10x your money. We are talking about nearly a millennia of percentage points. I wanted to start here because this single figure really demands our attention. It establishes exactly why we need to understand the mechanics of this business. This isn't some speculative startup. This is a wealth-generating machine that has rewarded long-term shareholders in a historically significant way. But, the past is the past. What about right now?
To figure that out, we're using our analyst's scorecard. We'll map out the scale of this trillion-dollar giant, unpack its growth engine, audit its Fort Knox financials, explore the new dividend era, and finally ask, is the price right?
Part 1. The Trillion-Dollar Giant. Let's talk scale and dominance.
We really need to set the stage here with Google's sheer size. When we say giant, it's not an exaggeration. We're looking at a market capitalization of $4.237 trillion. Trillion with a T. To put that into perspective, you could buy the entire GDP of several continents with that. Usually at this immense gravitational scale, growth just kind of grinds to a halt because it becomes physically difficult to move the needle.
But Google? They are totally defying financial gravity. The year-to-date return sits at a respectable 10.76%. But take a step back to the trailing 12 months, a 115.05% return. And over the last 3 years, tried 225.10%. Despite carrying a $4 trillion weight on its back, it's continued to deliver these exceptional market-crushing returns. It's moving like a nimble mid-cap stock, which is frankly wild.
Moving on to Part 2, unpacking the growth engine, acceleration over time.
So let's pop the hood on the actual business operations. Notice the top line. Revenue growth over the trailing 12 months is a very solid 15.09%. But look at the net income figure right below that. Net income has surged by 32.01%. This massive acceleration? That is exactly where Google's deep investments in AI are paying off. By integrating AI into search and ad targeting, they're radically boosting engagement and efficiency. They aren't just selling more, AI is making them vastly more profitable with every new dollar.
And when you apply that 32% AI-fueled growth rate to a company of this scale, you get an absolutely eye-watering number. Over the last 12 months, Google generated $132.17 billion in net income. That's pure profit, left over after the servers, the salaries, and those massive AI research budgets are all paid up. $132 billion. That is a level of cash generation that very few entities in human history have ever touched.
All right, Section 3, Fort Knox Financials. Balance sheet strength.
Now, massive profits are awesome, but how structurally sound is the foundation they're built on? To gauge that financial strength, we look at a metric Wall Street analysts obsess over, return on invested capital, or ROIC. Basically, this measures how efficiently a company takes the capital it has, invested into the business, and spits out profits on the other side. It is the ultimate test of management skill.
And Google's result on that test is an ROIC of 27.97%. Just to give you some context, a standard quote-unquote good company usually hovers around 10 to 12%. Pushing nearly 28% proves that Google possesses an elite tier of capital allocation. Every single time they invest $1 into their ecosystem, they're generating an outsized return. It means the company isn't just huge, it's astonishingly efficient.
What's crazy is they're pulling off that efficiency without borrowing aggressively. A debt-to-equity ratio of 0.12 is incredibly low. In the corporate finance world, anything below a 1 is generally considered safe. So 0.12 means Google has virtually zero debt leverage. They practically own their immense mountain of assets completely outright. If a major economic storm hits, a company with a 0.12 debt-to-equity ratio doesn't even blink. They're basically bulletproof.
Combine that practically non-existent debt with a net profit margin of 31.12%. Think about that.
For every dollar Google takes in, whether from an AI-powered search, a YouTube ad, or cloud computing, nearly a third drops straight to the bottom line as pure profit. It's a remarkably high-margin business sitting on top of a completely unleveraged balance sheet.
Section 4. The New Dividend Era. Returning Cash to Shareholders.
So what exactly does a company with zero debt and $132 billion in profit do when it literally runs out of things to buy? Well, they start paying a dividend. Now, sure, a 0.24% dividend yield might seem completely underwhelming at first glance. If you rely on yield to pay your bills, 0.25% isn't getting you very far, but looking only at the yield is a total rookie mistake. We gotta look deeper.
Because the crucial point is really in these payout ratios. Google is only paying out 7.69% of its net income and just 13.86% of its free cash flow as dividends. And they've only been doing yearly increases for 2 years because the program is brand new. That microscopic payout ratio acts as a massive safety net. It means Google could double, triple, or even quadruple its dividend payment tomorrow and barely feel a dent in its cash flow. You aren't buying this for the yield today, you're buying it for the massive runway of dividend growth tomorrow. Finally, Section 5. Is the price right? Valuing the giant.
We've seen the flawless fundamentals, the AI growth engine, the fortress balance sheet. But now for the climax, separating this phenomenal company from the actual price tag of its stock. Are we paying too much for perfection? Have all the good news and massive margins already been priced in? Let's check the valuation models.
And here is a stark reality check. The current market price sits at $347.31 a share. But when you run a discounted cash flow analysis, which calculates what a company is inherently worth based on its future cash flows, the fair value price comes out to just $190.53. The market is currently charging a pretty massive premium over what traditional cash flow models say the company is intrinsically worth.
Which leads us to this rather dramatic number, a margin of safety of negative 82.29%. Look, a margin of safety is supposed to protect you, right? It's the discount you get for buying a stock below its fair value. A negative 82% highlights some extreme valuation risk. It clearly punctuates that investors are paying a steep premium right now, and there is absolutely zero room for error if Google's growth were to slow down.
This brilliantly illustrates the tug-of-war going on in the market. The price-to-earnings, or PE ratio, is 32.13. That's high, and it's trading at a 26% premium compared to its own 3-year average. So yes, historically expensive. But, and this is a huge but, look at the PEG ratio. The PEG ratio divides the PE by the company's growth rate. Anything under 1.0 is considered undervalued based on growth. Google's PEG ratio is 0.88. This suggests that while the stock looks terribly expensive on the surface, that massive 32% net income growth rate might actually justify the premium price tag.
And that brings us to the end of our audit. I want to leave you with this final thought. You've got a company generating $132 billion in pure profit, zero debt, staggering AI-driven margins, and a brand new dividend with endless room to grow. But the market knows all of this, and they're charging you a steep 32 times earnings to own a piece of it. So, as an investor, you have to ask yourself, is a fortress balance sheet worth a premium price tag? I'll let you weigh the data and decide for yourself. Thanks so much for joining me on this explainer, and keep questioning the numbers.